just to jump right in, it isn't great out there right now, but it's still fairly busy, and I'm not just saying that because I have this mothering thing to do right now. I actually think it's a pretty busy time out there for lots of reasons. When I say it ain't great, if I was sort of looking back at previous talks that I've done here, and a year ago, so last September and last November, and certainly in January, I was really, really optimistic, right? That the commodities complex was about to get going. There was all kinds of reason to believe that. We had volatility rising in the broad stock market. Because of that volatility, we had the generalist investor getting worried that this long bull market was getting old. Did they need to diversify, look for something else? Big generalist fund managers started saying, well, commodities are the way to go. And that argument makes a lot of sense. That was present tense, it still makes sense, but it made sense when they said it a year ago as well. Commodities are one of the only sectors out there that have not participated in this broad bull market, and in the later stages of an economic expansion, demand outstrips supply, especially because commodities are always behind the 8 ball, so the new projects aren't there yet. And so there was lots of reason to believe that the commodities complex as a whole was getting set to go. And then gold, which is a bit of a weird commodity, of course, there were lots of reasons to believe that it was going to get some good impetus as well. Everything from anything to do with Donald Trump, there was lots of angst about North Korea, what was Brexit going to do? And those arguments all made a lot of sense. Well, then we had 2018, which has been so far pretty darn boring for metals. So what happened? Instead of all of that excitement, we're at a point where metal sentiment is fairly terrible, right? I mean, it's sideways. There was just this large conference in Beaver Creek, which is supposed to bring corporates, teams from the major mining companies and mid-tier mining companies face-to-face with all the juniors, so that they could, and with fund managers face-to-face with the juniors, so everyone can learn what each other's doing. And sort of the most positive comment that came out of that conference was, we're trending from negative to neutral. You're like, great, I'm so glad I do this. But, so why is that? Well, all of that volatility and angst about the broad stock market just poof, it disappeared, right? And so why would investors do anything other than invest in that chart, right? That's what a bull market looks like. That's what they're still doing. And fair enough. We can't fault them for continuing to do what has worked for the last 8 years and what is, at this point, continuing to work. If you want proof, I don't think most of you need it, but if you want proof that there's no interest in metals or very limited interest in metals, take a look at palladium. Palladium is like the only major metal out there that's getting close to all-time highs in its spot price. You'd think that would cause excitement, but instead, ETFs have been selling, like, consistently for the last 4 years. For the first 2 of those years, 2014 and 2015, the price did decline, but since 2016, the price is up 130%, but the ETFs keep selling. So there's some good proof that the sentiment is just really not on our side at the moment. What's fueling that continued bear market is simply the fact that despite data from America that is mixed on a day-to-day basis or a week-to-week basis. We certainly get mixed economic data out of the United States, but on the whole, it's still positive. There's still lots of reason to believe that this is going to continue. Sort of, if you want to look just this last week, there was this raft of data that came out almost coincident with the decision to raise rates again, which was no surprise, and that just continues the belief in investing in the broad indices. And fair enough. And against all that, of course, we've had these trade wars. I'm quite sure that others, probably Eric, will talk at length about what they think the specific impacts of trade wars will be. At this point, I think the takeaway is just that trade wars have basically if people have had concerns about what's going to happen because of these trade wars, the only safe haven that they've gone to is the US dollar. There's just been no move to gold, and you can see the different trends, the US dollar going up and gold going down as that has happened. Okay, so does the US dollar make sense as a safe haven? Well, right now it does, absolutely. For one thing, you don't fight the tide, and that's where the tide is going. And in the short term, tariffs are likely to have, it's going to take time, right, for these tariffs to have significant impact on growth, let alone inflation. But in the longer term, tariffs are inflationary. They're higher costs that US consumers have to pay for the goods that they buy a lot of from China. And so if these tariffs continue to be implemented, it is a fairly strong inflationary force and it's anti-growth. So in the longer term, and by that I just mean beyond sort of 2019, the US dollar as a safe haven against trade wars doesn't make a lot of sense anymore. And instead, gold gets some lift from that argument. We just have to have a little bit of patience because we're not quite there yet. As for the very moment, is the US dollar topping? It's starting to look a little bit like that. I'm no US dollar expert, but it looks to me like despite all of the support that it's gotten, it has been starting to break down. So I think it's quite likely that the US dollar, that August high that we saw, might be it, at least for the near term. Okay, so if that's the big picture situation, US economic strength, the dollar's the safe haven for whatever it is for now. What are some of the threats to that situation? Well, there's lots of big picture things, right? You can see that outlays versus receipts for the US government are trending in opposite directions in the way that doesn't work for the US fiscal position. No one cares about that yet, but that's there in the background, and that's a rabbit hole down which you can spend a huge amount of time. More close at hand, of course, are the midterm elections. And there's Americans here, or those who follow American politics more closely than I do, who could talk about this at length. But at the end of the day, it's a source of volatility, and there's a possible, if the Democrats take the House, then you get sort of a lame duck presidency at the worst, or at the best, and the potential for impeachment proceedings at the worst, which I mention only because that's bad for stock markets. Whenever there have been impeachment proceedings in the past, the stock markets have not done well. So these are sort of, you want to call them arm-wavy, big picture threats that are coming to this rosy situation, but none of them are guaranteed. Inflation is more guaranteed. The picture there is the cover of Barron's magazine last week. And so that's pretty interesting, right? Like for Barron's magazine, which is a fairly widespread economic magazine, to have that as its headline article, you know, that's interesting. So inflation is coming, gold is cheap. That's a really fundamental argument. So it's nice to see that out there. I think that understanding exists, but some of these threats have to manifest. They have to be a little bit more obvious before we're going to get any momentum pouring into that. Okay, so if that's sort of the big picture, it all sounds fairly dire. It all sounds like, why are we here? What's the point in the near term for investing in the metals complex? Well, I think there is. So beyond the US dollar, there is reason for metals optimism beyond just hope that the US dollar is topping and that will encourage metal prices. Gold seasonality is a fairly, I mean, you probably hear people talk about that more than you might want to. We did not get a run this fall, which is usually one of gold's strong seasons, but the new year is just as or oftentimes stronger in terms of a seasonal effect for gold. So there's a good chance that we'll get something going on then, especially if things happen in November in America. I don't know exactly what those things would be, but that could encourage gold to have some legs in the early part of next year. As I've said, inflation certainly has to show up at some point. And what really matters with inflation, sure, it weakens the dollar, and that helps diversify people's search for a safe haven. But what really matters, of course, for gold is real interest rates. So federal funds, or interest rates minus inflation. And because the rate hikes have been so gradual, we talk about them so much, it seems like there's this dramatic rate increase going on, but we've managed to add 2% in 3 years. That's actually a very slow pace of increase, and so it doesn't take very much inflation at all to keep real rates of interest really low. So that, I think, I have hope for that. I certainly have optimism that that is going to show up at some point. Base metals are way oversold based on trade war fears. Unless the trade wars end up being like the very worst case scenario that they could possibly be. Oops, sorry, I was trying to see my timer down there so that I knew approximately how long I'd been talking. Unless it's the very worst case scenario, the fundamentals for copper and for zinc in particular are really strong. And so the price sell-off that we've seen, the spot price sell-off that we've seen since this trade war talk started, has been way overdone. So there's definite opportunity for a near-term run in base metals. And then unique value. I started by saying we were really optimistic at this time last year because the metals complex offers this unique undervaluation against a bull market that has gotten long and strong, that is very much still the case. The argument that demand outstrips supply late in an economic expansion is very much still the case, because we've all been watching and there aren't a huge number of new mines that have suddenly come on stream to start feeding all of those supply gaps. They still exist. So all of those fundamental arguments still make sense. Commodities are still one of the only undervalued sectors in the market, and so anyone who's searching for value will make that turn at some point. That is still definitely going on. So let's look a little bit more at some of those opportunities. I said that base metals are certainly oversold. Well, they really, really are. If you look at, I mean, there's the one-year copper spot price. Doesn't look like a very exciting chart, but the chart just below it are the premiums that traders are paying in Shanghai to get their hands on physical copper today. Those premiums are really high. So that says that they are having trouble physically getting copper. It just isn't there. Supplies are very, very tight. I didn't have room on this slide to also put stockpiles, but stockpiles of copper have been declining quite significantly. They're pretty low. So people are paying lots to get their hands on copper because there's not very much in the stockpile and there's not very much available. And then you look at the chart, the copper market balance, demand is only rising. Everything that is going on with electrification demands copper. That's nothing new for any of you to hear, I'm sure. And the fact that we are so short on new copper mines, copper's a really big market, right? We need to produce 20 million tons of the red metal every year. That's a very large market, and it relies on some very large mines to feed those big numbers. And we just don't have those big mines coming on. We have some shutting down, but we don't have big ones coming on because the bear market, because. And so we're looking at a situation where from sort of 2025 to 2030, we're going to be short 5 million tons of copper every year. That's just not possible. The world can't work short 5 million tons of copper a year. It just doesn't happen. And so the price has to increase to encourage new mine development to feed that gap. Now, when I'm talking about 2025, it seems like that's a long time frame, but at the end of the day, the fact that stockpiles are low now, premiums are high now, and everybody who's in the copper world is very aware of this fairly looming significant shortfall, prices are going to strengthen for copper. Zinc. So we certainly, the top chart there shows zinc stockpiles in inventory. And certainly what drove zinc's huge price gains in 2016 and 2017 was the fact that those inventories had fallen so much, right? That's a very consistent decline. And then in 2018, you can see that chart flattened, stockpiles started to rise a bit, people maybe decided that the problem was solved, the price came off a fair bit, but just like in copper, the problem isn't solved. Zinc also relied for many years on several very big mines. A bunch of those mines have shut down. The new mines are not really available yet. The deficit is still very much present, and so there's still a lot of opportunity in zinc. Now, are zinc prices going to rise a lot from current levels? Probably not dramatically, but where the opportunity for zinc lies is in the equities, where what we're really short on are the new projects. So if you can identify the projects that actually have the opportunity to feed into that supply gap, those are the projects that are going to demand a lot of attention and therefore get bought and built. Okay, so that's base metals. There's opportunity outside of that for those who are engaged in the sector. So if you are, like I am, bullish on metals in the medium term, I'm not necessarily thinking that this market's going to turn around tomorrow, but as metals investors, you're not generally trading for tomorrow. You're trading because you have a fundamental perspective on this sector. And so if your fundamental perspective is bullish, then sideways markets are a time to position. So I just wanted to go through some of the things that I'm looking for these days in doing that, in trying to use this as an opportunity to position. What am I actually looking for? So in terms of positioning, there's a lot of fundamental value. There's some very good warrants out there. There's hidden gems that are being unlocked. You can go back to basics with producers. Base metals are oversold, as I've said. And then in the meantime, there are some stocks that are just killing it. So that's pretty fun too. So the stocks that are just killing it are real discoveries. And the obvious example, the chart that was on the previous page, is Great Bear, who I think we're hearing from next. Great Bear has a very exciting high-grade gold discovery in one of the world's most famous high-grade gold camps, in a brand new project, as in like a real new discovery, and the market is really responding. And that's exciting, right? So as much as sentiment is terrible, there are still people paying attention. And we've seen some reactions. I mean, Great Bear's numbers are phenomenal, so it would be devastating if there wasn't some reaction to those. But we're seeing reaction to results that aren't as phenomenal as that as well. There have been companies that have reported long, reasonable porphyry intercepts from a new discovery in BC, and their share prices have done really well. So that is helpful to me as well, because it shows that people are paying attention, and there is still money looking for the next great discovery, and confident that there's opportunity to make a bunch of money the way that the metals sector offers, if you can pay attention to those, if you can hitch your horse to that wagon. Now, of course, those are hard wagons to pick. So the things that you need to pay attention to beyond geology, of course, when you're talking about an exploration story, geology really matters. But beyond geology, if you're convinced of the geology, then I would say pay attention to share structure as one of your leading causes. So you want there to not be very many shares out, so that whatever value is added to the market cap means more value per share, right? The more shares there are, the less value per share you get. So tight share structure is really important. Does management have access to capital? Can they actually move the project forward? Can they make the discovery? That's important. And do they have a plan? There's a lot of geologists out there, bless them, who get very excited about a project. They talk about all the different ways that it could work, all the different targets that they've got. That's great, except I want to know what you're going to do. If I invest, if we raise $500,000 for you tomorrow, what are you going to do with it specifically? And if that doesn't work, what are you going to do next? And if that does work, what are you going to do next? I want you to have a very clear plan for what you think you have, how you're going to test it, and what you're going to do next if it works or doesn't. And it's surprising that that can be lacking. It's surprising how often that is actually lacking in junior exploration companies. Strong and savvy management. So strong management helps with those previous points. By savvy, what I'm referring to is the ability to tell the story, and having the right people to tell the story to, having access to the people who on hearing the story might put money in, or might tell their friend who might put money in, right? Management has to be able to do more than the technical side of things. And then, of course, good geology. Now, my last line there is, if you do pick a winner, manage your risk. So Great Bear's share prices stayed up. That's fantastic. They've got a lot of momentum. Other discoveries, the market's expectations for the next hole are like really high right now, right? So don't assume that the next hole is going to be better and that the share price is going to keep going up. Even Great Bear actually reported a better result yesterday, and their share price only stayed flat, which was a bit surprising. But others have reported worse results, which is very common, and they've given up almost all of their gains, right? So the market's demands are really high right now. So if you do pick a winner and you get a good multiple on your entry point, I would recommend taking some capital off the table, right? I'm sorry to say that to the issuers in the audience, but that is a legitimate aspect of the market today. Oh gosh, I got to get through this quickly because I only have a minute left. Good thing Eric gave me his 10 minutes. No. Okay, so other opportunities today. I'd say there are exciting news stories, and this style of exciting news story is something that is unique for this time in a metals cycle. So when we're early in a new metals cycle, there are certain kinds of stories that come out that don't come out later in a metals cycle, and let alone certainly not in a bear market. So hidden gems being unlocked, I'd say the long, dark bear market means that good, really strong management teams are able to negotiate to extract projects from majors' portfolios. Majors love to hold on to good projects and not do anything with them forever, and then those projects get forgotten. But really good management teams can extract those projects and then turn them into their own opportunities of their own, and there's some examples of those situations at the conference right now. New producers being built. Divestments by majors have created opportunity for new producers to take on assets that majors probably weren't giving a lot of attention to, or that just can be better valued in an independent vehicle. So Equinox Gold is probably a pretty good example of that. They've obviously just made a deal to buy a mine, so they're going to be a producer now. They're building another mine. They're developing a third one. Ross Beatty is planning on building a brand new mid-tier gold producer. That's unique for this time in the cycle to have the opportunity to enter early in a story like that. The chart there is nothing new to anyone here, just shows how bad sentiment is. This type of chart, basically the farther you are down in this corner, the less people like your stock. And these are all mining stocks. So that's where we are. And that clearly means that there's a lot of fundamental value out there. If you're bullish on metals, producers are available at good prices. If you think metals prices are going to rise, obviously that you can buy them now, and you can just hold on to them until that situation plays out. Quiet successes. There's a lot of good companies out there that have made good progress in the last 2 years. They were able to raise some money in 2016 when things got good. They've made good progress on their assets, but the market hasn't paid the slightest bit of attention to them. The challenge there is making sure there's some sort of near-term catalyst where you have confidence the market will start paying attention. So those near-term catalysts have to be something fairly significant, maybe a resource estimate that the market's really not expecting from having not paid attention. Or maybe it's a PEA that's going to demonstrate that this asset that for years nobody paid attention to is actually really makes a lot of economic sense. If you can come up with a rationale for near-term excitement, then some of these really cheap stocks become exciting in the near term. Warrants financings are still not easy for a lot of explorers out there. Some of them can raise money at the drop of a hat, but most of them can't. And so if you like an exploration story, if you've been behind it for a while, the warrants are available in the financing, so that's your ticket to ride down the road. And then, of course, mergers and acquisitions are heating up to some extent. The Aussies are more active. Apparently Barrick wants to buy Randgold. That's interesting. I'm not suggesting that we would have identified Randgold as the target, but standards are really high, but people are on the hunt. So if you see a new producer, a development stage asset that's got permitting well in hand, assets that make a lot of economic sense, these things will get taken out. So those are good opportunities to position as well. And then I was just saying, copper, zinc are really oversold at current levels. And uranium is another interesting one. I could have spent 20 minutes talking about uranium. If you want to talk more about uranium, I'm happy to outside. The short version is that the producers are forcing the market to change. They're sopping up all the excess in the spot market, and that's actually lifted the price 30% in just 4 months. And I think the tide is turning on uranium. This is just briefly, big picture-wise, investing in this sector. If you want to do well, it's not easy. When the market starts raging, sure, buy anything. But if in all but those short periods of time, it's not super easy. So there's certain requirements to do well in this sector. I think you need to know a lot of people. You need to rely on their information. You need to pay attention all the time. You need to manage your risk. And you need to pay attention all the time. And that's what I spend my time doing. These are my offerings. I do the Maven Letter, which is published once a week and is designed for investors who are somewhat to fairly familiar with the metals space. And so there's a fair number of high-risk exploration stories in there and somewhat more advanced conversation about what's going on. Maven Metals is my newer letter that's once a month, and it's for the generalist investor who sees opportunity in the space but doesn't know a lot about metals, so an introductory level offering. And premium is for those who like to participate in private placements alongside me. I'm usually like super on time, and amazingly I was 4 minutes over. So thank you, Eric, for those 4 minutes. I apologize for taking them, but now I will move right on. And I don't really need to say anything more other than Chris from Great Bear is going to come up and tell us more about the story that I teased you about just now.